Hi there. I want to talk to you about how to build an enduring investment portfolio. Years ago, I read this book, The Richest Man Who Ever Lived. It's a book about Jacob Fugger. If you Google him, he's one of the 10 richest men that have ever lived. King Solomon, all of them. He lived in the 14th century. He had an investment philosophy, and I'm going to share that with you today. But fast forward to the early 1970s. We had inflation running high. We had the oil embargo by OPEC in 1974. And there was this gentleman by the name of Harry Browne. And he talked about a permanent portfolio, one that would endure over time. Fast forward to the 2000, and there's a gentleman by the name of Ray Dalio who runs Bridgewater. And Ray has the all-weather portfolio. And as I studied these men, what came out was certain themes that you should have in your portfolio. And so what I'm going to talk about today is how do you build a portfolio that can give you a high probability of achieving the investment returns you need to get to your financial goals. So the first thing I want to talk about is there are 4 economic conditions. The first one is prosperity, and the second one is recession. Prosperity, the way I think about it is we have low unemployment, we've got a strong middle class, consumers are out spending, things aren't too expensive, there's good mojo. And in times like that, you want to own stocks, and you could own Canadian, US, or global. The second economic condition is recession. Let's say my wife and I, we have small children, we run up our credit cards, we're spending a little bit more than we should, and we have a family meeting, and we decide, well, let's not go out and eat so much, let's just prepare our meals at home, let's not go to the movies. And what we do as an individual family is we curtail our spending. That's fine if Lance and Kathy do that, but if 1 million Lance and Kathys in Canada do it, the economy slows down. That's called a recession. It has a natural course. The challenge is the governments don't like to do nothing. So they try to affect recessions, and they do it 2 ways. One is with monetary policy, and one is with fiscal policy, okay? So fiscal policy is with interest rates. And traditionally, when you build a portfolio, you want to have bonds. Now, bonds are simply IOUs. You lend money to the government or you lend money to companies, and you get paid a rate of interest, and when the bond matures, you get your money back. But the pricing of bonds works on a teeter-totter approach. Here you have the bond, and here you have interest rates. For about the last decade, until the beginning of 2022, we had a period where interest rates, the government was lowering interest rates through the Central Bank of Canada, and in the United States, the Federal Reserve. So what happens when interest rates go down, bonds go up. Why is that? Well, if I have a bond that's paying 4% interest, and interest rates get lowered to 3% interest, and I sell my bond, the person that buys it has a contractual guarantee to get 4% interest. So why would I sell it except for a premium? So I get paid more money for my bond so that the effective interest rate is now 3%. Well, the other thing that happens is when interest rates go up, bonds go down in value. The other impact on bonds is inflation, and that comes from the government's monetary policy. If governments print a lot of money and put more into circulation, I know of nothing that gets more valuable when there's more of it. So the dollar loses its purchasing power. And if the only thing I get from a bond is interest, and then I get my money returned when it matures, if money, because of monetary policy, is losing its purchasing power, bonds can become less valuable. And so traditionally, people have a balanced portfolio made up of stocks and bonds. You might hear words like 60-40, 70-30, 60% in stocks, 40% in bonds, 70% in stocks, 30% in bonds. But there's two other economic conditions that Jacob Fugger talked about, Harry Browne, Ray Dalio, and many others. In fact, it's something I talk about. One is inflation, and the other is deflation. So what is inflation? Years ago, my son had to do a project in grade 8 on money, and one of the topics was inflation. And he said, "Dad, what's inflation?" And I said, "Okay, son, you've got a TD bank account. You put $100 into it on January 1st. On December 31st, you go to the bank and say, 'Give me my $100.' And they go, 'Here's $98.' And you go, 'Where's the other $2?' And they go, 'Oh, that's inflation. It's good for you.'" My son said, "That's kind of stupid. When the government talks about targeted inflation of 2%, what they're really saying is we are going to reduce your purchasing power by 2% every year. If inflation's 2%, that means every 36 years your money loses half its purchasing power. But if you're getting pay raises of 4 and 5%, you don't see it. See, inflation is the friend of the debtor and the enemy of the saver. Who's the biggest debtor in the world? The government. And if you think about it, you borrow money today and then you pay it off over time. And if the dollar is getting less valuable, you're paying off your debt with less valuable money. Now, most people don't pay attention to inflation when it's 1 or 2%. But over the last couple of years, when it's running at 6, 7, and 8%, people start to wake up. And when inflation runs high, people like to invest in real money, gold and silver. They like to invest in real estate, infrastructure, commodities, and farmland. I drive on the 407 sometimes. Last year, let's say it was 30 cents a kilometer. Well, this year it's 33 cents a kilometer. That's a 10% increase. It's built into the contracts of infrastructure. That's not great if I'm a user, but it's great if I'm owner. It protects me in times of inflation. If money is getting less powerful in its purchasing power, is the commodity going up in value, or is what we're paying for it going down in value? The other one is deflation. About 2009, during the great financial crisis, I belonged to an organization called CALU, and we have a conference every year up in Ottawa. And we have the Prime Minister come speak to us, the Leader of the Opposition, the Governor of the Bank of Canada, and the Minister of Finance. And I remember Stephen Harper came to talk to us, and he was talking about deflation. And he said, we must fight deflation. And I was thinking to myself, why? And then it dawned on me. See, if I'm making $80,000 a year and everything falls in price, deflates by 10%. Think of it this way. If a new car is $37,000, do I want to pay $37,000 or $34,000 for it? If I want to buy a dress shirt, do I want to pay $100 or do I want to pay $80? If I'm a consumer, deflation is good for me. I can buy more. But see, if deflation is 10%, I get a 10% pay raise, but the government can't tax it. What the government would prefer is if my salary is $80,000, I get a 10% pay raise to $88,000. Guess what? They get 30% tax. I don't actually get a 10% pay raise. And the other thing is, deflation is the friend of the saver and the enemy of the debtor. If I borrow 100 grand and then every year the money's getting more valuable, guess what? It was a poor decision to borrow money. Who's the biggest debtor in the world? The government. And during deflationary times, cash is king. Now think about the great financial crisis of 2008. You would hear things like, oh, the stock market fell 40%. I'm going to ask you to consider a different word. The stock market deflated 40%, but your cash didn't. So now, after all this education, what does that mean to building a portfolio? I'd like to think I can tell you the future, but I can't. If I could, I probably wouldn't be standing here doing this video. So when you're building a portfolio, Wouldn't it make sense to have money in each one of these asset classes? And the reason this is important is something called correlation. If this is your return and this is time, if you have one asset, we know things go up and down. The holy grail of investing is called perfect negative correlation. So what would that be? You buy two assets that behave completely differently, so if you have this nice smooth growth over time. Guess what? It doesn't exist in the real world. However, if I have assets that behave certain ways in certain economic conditions, what it makes sense is you don't want to have to sell when the economic condition is bad. So think about 2022. The S&P 500 fell about 17%. That's a major stock market in the United States. The NASDAQ was down 33%. Well, what happens if you're retired? You don't want to be selling when things are down 17 to 30%. But interesting, gold and silver, commodities, infrastructure were up last year in 2022. And so now all of a sudden what it means is you can have a diversified portfolio that grows over time, but if you need to access money, you're able to draw from assets that are up when other ones are down. And there is no free lunch. It's called tinstaffel. There is no such thing as a free lunch, but there is a cheap dessert, and that's called rebalancing. And I'll give you an example. August of 2018 to December of 2018, the stock markets in North America were down 17 to 20%. Gold and silver were up 10, as were commodities. We happened to rebalance portfolios on January 1st. So we were actually selling an asset that was up for the year and buying assets that were down. It's what is known as the rebalancing premium. And here's the thing is, if you have a properly diversified portfolio, you should always be upset at one asset class. Because if everything's going up at the same rate of speed, you don't have a portfolio, you have a bet. Now, there may be times when you want to take bets, but for most people with serious money, in fact, the clients that we work with, a lot of them is, Lance, we won the game, grow this money prudently over time, don't put it unduly at risk, don't lose it. And so it's through this process of following 500-year-old investment ideas. Jacob Fugger, Harry Brown, said break your money into four parts: 25% into enterprises, 25% into loans to the crown, bonds, 25% in real estate, and 25% in gold coin. Now you gotta understand, is in the 14th century, gold coin was cash. And so this is an idea that we bring forward to our clients, and that depending on your unique circumstances and where you are, the percentages we put in each of the quadrants can change. But now you have a mental construct to understand, why did the portfolio behave the way it did? And then where are the opportunities to rebalance? One of the things we offer is a free portfolio audit. If you'd be interested in that, what we do is you send us your portfolio statements, we run it through our diagnostic software, and we can give you a report on how well you're diversified. If that's something you'd like to do, my contact information is below. I hope you found this informative, and I look forward to discussing how we can help you with your portfolio. Live well, pay less tax.